Welcome back. You're listening to Houston Real Estate Radio. I'm your host, Shanna Register, and we try to bring you great information every week. Right now, we're in our summer book tour. We're trying to give you some great reads for the summer and having a lot of fun with it. If you've got a real estate question, give us a call, 844-788-9444. That number again, 844-788-9444. All right, I have a great book for you to read this summer. One of the books we're doing is Man Cave, which is just such a fun book with lots of pictures. This one doesn't have so many pictures, but this one is really good for first-time home buyers. It's a comprehensive guide for first-time home buyers and home buyers getting a mortgage since the mortgage crisis of 2008. It's called How to Get Approved for the Best Mortgage Without Sticking a Fork in Your Eye. And if you have tried to buy a house in the last 2 years, you know that it's gotten more and more difficult. This really is an interesting read. It's by Elysia Stobbe, and I've got her joining me. She's Skyping in from Florida with some great information that we pulled out of the book to share with you. This is a great read for the summer if you're getting ready to purchase a home. It's like the perfect thing because it's got all these checklists in it that are really, really great for a first-time home buyer. So I really liked the book. Thought it was a great read. Maybe not so much at the beach, but definitely a great read for you over the summer. And just take it slow and steady and get through the whole book because it's just chock full of great information, and make notes. If you're like me, you dog ear and star things. So I have lots of that going on in the book. So welcome to the show, Elysia.
Thank you so much for having me.
So this is a great read. I figure if people have all summer to read it, they can just slowly get through it because it's not a hard read. But if you're not familiar with the housing industry and the lending industry, there's a lot of terms and things in it that you kind of got to let soak in. It's not like you can be watching the kids at the beach and reading this at the same time, right?
Yes, yes.
So some of the things, I know this book really focuses on first-time home buyers. I want you to go over some of the monumental mortgage money mistakes to avoid, because sometimes first-time home buyers can't get a loan and they've done things that they don't know they shouldn't have done that are preventing them from getting a loan. So can you go over those for us?
Sure. The three monumental money mistakes, the first one is actually not getting pre-qualified or getting pre-approved. And some people get overzealous. They get out there, they're shopping, they find the house they like, they're under contract, and then lo and behold, they don't actually close on the loan.
Hopefully, if they've got a realtor, their realtor's not letting them do that. But
yes, I agree. I completely agree, because we want to make sure people's expectations are in line with what they actually qualify for.
Yes.
So that's really important, and you just want to make sure that you're aware of your credit, that you're trying to save, you have a pattern of savings, you're responsible and you're paying your bills on time, you're aware, and also medical collections sometimes pop up on people. They can creep up and people don't necessarily know, and all of a sudden they have a collection on their credit report. So you want to be aware of all those things.
Okay, let's talk about one of the big things that always drives me crazy about people. They will shop for a mortgage based on the mortgage rate. It drives me crazy. I hear it all the time, but I can go here and get a better rate. I can go here and get a better rate. Explain it. Please explain it well so they'll stop doing that.
Yes, I actually teach a first-time home buyers class, and this is so important because many people shop on the rate thinking that's the most important. And it is. Everybody wants a great rate. You want to get a great deal. There's no doubt about it.
Yeah, but there's more to it than that.
Yes, absolutely. There's different loan programs, and different loan programs, it's cyclical. And right now, government rates, for example, like FHA, VA, USDA, they are a little bit lower than conventional. And it's been that way for a while, but sometimes it's a trend that can change. And you may get a lower rate with one of those type of loan programs. But for example, with FHA, the mortgage insurance is going to be higher than a conventional loan. And with FHA, now the mortgage insurance is for the life of the loan. And you could be spending tens of thousands of dollars.
Yeah.
Plus with an FHA upfront funding fee. And FHA is a great loan if that's what you qualify for.
Right.
But I really encourage people to do the research on your lender.
Right.
Do a true application and have the lender come back to you and tell you all the loan options that they have, all the programs that you qualify for.
Right.
Based on your funds, your down payment, your credit score. And then from there, you can actually go through the pros and cons with your lender of each loan, because they all have different benefits, and they all have, for example, seller assistance also varies by the loan type. So you could leave money on the table not knowing that you had that available with that loan program.
And when you compare mortgage company, let's say you choose FHA, now you're comparing mortgage company to mortgage company. You still can't look at just rate. You have to look at what they're charging you.
Yes, absolutely. Excellent. So box A on our new closing disclosure, which used to be the 800 section and the good faith estimate, which we haven't had for years. But anyway, that's always a changing document, apparently. And and also when you're looking at closing costs, it's so important to review that with each of the lenders you're shopping, because at the beginning of the loan, many numbers are estimates. Your homeowner's insurance, for example, one lender could estimate it higher or lower than another, and that's your closing cost. But you actually shop for your homeowner's insurance. So if you get a lower rate, a lower annual payment on your homeowner's insurance, all your closing costs are going to come down, but people don't realize that. So it's really box A is what you're looking for when you compare lender to lender, and those fees. And then there's also another little section in there that you can shop for, such as appraisal you can't shop for, credit you can't shop for, but there's other things like survey that you can. And then, of course, the title company, too.
Sure.
The title company, that's a third-party fee.
Right.
The lender usually doesn't know those when they send you that before you're under contract. So it's important to ask those questions. Where are these numbers coming from? And even more importantly, which of them are likely to change during the loan process?
Yeah.
And who is responsible for that?
I like that. Box A. I'm just going to remember box A. Look at box A. Okay, so let's talk about closing costs. You mentioned closing costs. And the thing about closing costs is all first-time home buyers, they want to ask their realtor how much my closing costs going to be. And their realtor says, I don't know, ask your lender. Go over closing costs with us. What is included in that?
So closing costs I break it out into two separate pieces. So there's actually the cost to close your loan, which are things like appraisal, title fees, recording fees that go to the state. And then there's escrows. So that's a whole other piece. They call them prepaids, is how you usually see them split on the loan application. It's actually on page 3 of the loan application as well, in a lump sum form, whereas the closing estimate puts it in line by line, item by item. So those prepaids are going to be your homeowner's insurance, so paid 1 year in advance by closing. And again, if you haven't really got a solid number on your homeowner's insurance, which you usually don't before you go under contract,
right?
You should be shopping that as well. But that number can change. And then you have prepaid daily interest. So typically the industry standard is going to do 15 days daily interest. But most of the time, people try and close at the end of the month, so that number usually decreases. And then you also have the escrows for homeowner's insurance and property tax. And the property tax, everything varies by state.
Okay. All right. Let's go back to those mistakes. I want to talk about those massive mistakes, because one of them are actually not just the mistakes, but what you need to qualify for a mortgage. I know that everybody thinks their credit has to be good. Everybody knows that. Everybody already knows, you got to have a house that will qualify, especially like FHA. You got to have a house that'll qualify. Don't go out and buy a car before you move, or a refrigerator until after closing. But one of the things that I feel like people don't hear enough and don't understand enough is that income to debt ratio. If they did, they wouldn't be co-signing on things. So yes, tell us briefly, how to avoid that mistake.
So for example, a lot of people think that it's great to have the furniture in your in the house the day you move in, or a new car in the garage. And that can be really exciting. But the challenge is with what's called a debt to income ratio. You actually have to, I'll just break it out. So the front ratio is actually your mortgage payment, which is principal, interest, taxes, and insurance. So those 4 main pieces. Then your back end ratio is your new mortgage payment, including those 4 pieces, and the minimum payments for any other debts you're required to pay. So student loans, car payment, minimum credit card payment, and different things like that. So if you're at the top of your back-end debt-to-income ratio, and different loans have different ratios. So again, this is something you need to ask your lender questions about, or they should be discussing it with you. So if that's the case and you're at the top of your ratio, and for example, you go out and get the car and put the car in the driveway,
right,
you may not be able to close on that house, and you don't want that.
Right. Yeah, that's not good. Okay, we have time for about one more question. So I want to ask you to explain something that a lot of consumers out there haven't even heard of. What is automated underwriting?
So there's actually two main forms. USDA actually has their own called GUS, but there's typically Fannie Mae has a version and Freddie Mac has a version. And we put all your loan information, so income, assets, your credit score, your full credit report, your job history, all goes into the loan application. And then we run it through an automated underwriting program. And that program will either come back typically with an approve eligible, and then it has all the loan conditions that need to be met. And that's what the underwriter actually reviews when they underwrite your loan with the information and data supplied by you, and also typically the processor, the title company, the appraisal, and things like that. Well, if it comes back approved ineligible, then that's a problem. Either there's a credit issue or not enough cash to close. And then it can also come back with a refer eligible, which means it has to be manually underwritten to the guidelines of that particular loan program.
So I think it's a good idea for consumers to know that term so they can actually ask their loan officer if they put them through automated underwriting to make sure that's not going to flag anything that's going to be a problem for them.
Yes, it's a great idea, and that's also the difference between pre-qualification and pre-approval. So you can get a pre-qualification from a lender, and a lot of times this comes to you've maybe applied over the phone or online and they pull your credit.
Right.
I think it's so important to actually have the lender review your income and asset documentation and run the loan through automated underwriting before you get in that contract, because once you're in contract, you're obligated to legally perform. So your appraisal's on the line, your money for that, your inspections,
you're spending
and your money deposit. A lot of money at stake.
Right. All right. Elysia Stobbe, she wrote a great book called How to Get Approved for the Best Mortgage. I really, just chock full of great little checklist and lots of information. So appreciate you coming on and being part of our summer book reading tour. I think that this is a good book for first-time home buyers that'll really help them understand about the lending process and getting approved for a mortgage. So appreciate you coming on.
Thanks so much, Shannon. All
right, we'll be right back after a word from our sponsors here on Houston Real Estate Radio. If you've missed any of today's show, or if you just want to watch this again, it's great information. If you want to see it again, you can catch it online at HoustonRealEstateRadio.com and see the video in beautiful HD. You can also go to iHeartRadio or iTunes as well. So we will be right back after a word from our sponsors here on Houston Real Estate Radio.